Hey, CGS investors, it is Monday, January 22nd. Taking a look at the charts, we'll start off with the big picture view here of the S&P, the SPY ETF. This is the weekly chart. This is kind of our long-term investing signals to identify when the tide is going up, when we are in a bullish phase. We need to know also when the market is in a bearish phase and out of favor. And of course, we are back into a bullish phase in terms of the tide going up and it's lifting most boats with it here. Overall, we broke last week to new all-time highs on the SPY. Very strong rally last year, and since this kind of uptrend had kicked into gear. And when we zoom into the shorter term time frame, our most recent trade here, we are up about 9+%, and we are seeing this market continuing to unfold. I think we're going to see a lot of potential short covering kick in here. I think we saw a lot of short covering actually kick in on Friday. So when the market was set to close for the week, had some new all-time highs with the SPY. I think a lot of people were covering their shorts, created a very strong run. And of course, it's also going to trigger people to want to get into the market who are not into it. When we look at the sentiment of the chart, when we have red bars here, that is when people are betting, they're fearful, and they're not only these people have sold their positions in the market, but they're betting on lower pricing. We had that again right here. Fearful, they're betting on the market to fall. And we had that about a week and a half ago, 2 weeks ago, they were betting on the market to fall again. Of course, when the masses do this, the way we read their sentiment, their actions, the market generally wants to go the opposite direction. So they're out of the markets betting on lower pricing, and they get left behind. The stock market rallies, and we are seeing that again after this was a lot of orange bars and red bars in here. This is a huge wave right here of a lot of people being very nervous and betting on lower pricing. And it's a pretty big section, meaning this could have a big unwinding effect and a big short squeeze and a lot of people piling in to the market. So we just had the market open right now. It is Monday morning, and it is opening slightly higher at this point. Now, if we take a look at the QQQ, it is up. Now it is up roughly about 13.5% from our entry price. Nice strong move there, very close to our next target at 15%. And you can see here, sentiment-wise, on the right-hand chart, we have very similar type of waves of fear in the market. And of course, after each wave of fear, the market rips higher and leaves those behind who are trading on emotions and literally trying to pick bottoms or tops in the market. Dangerous game, playing with emotions and trying to outsmart the market. You're much better to just follow the market. Picture the stock market as the leader, and all you got to do is follow the leader. Just follow their footsteps and track how close you want to track to that. Depends if you want to be a day trader or swing trader, or how we navigate the markets, kind of a bit bigger view. We want fewer trades. And we just want to catch the big waves that roll through the market each year, about 5 to 12 of those waves. All right, so let's go take a look over at the rest of the markets. Let's zoom in. Today we are seeing equities higher. The Russell 2000 is up the most, so that's small caps, growth stocks up about 1% this morning. They have had a nice rally and a bull flag pattern here. If we zoom out on the chart, let's go full screen here. It is a pretty major kind of bearish pattern still. We had the stock market put in a major top back in 2021. And then we've seen the Russell 2000 really trading in this next big, you could argue this could be a base. Maybe it wants to go higher. But at this point, it really is still a big consolidation to the downside. The trend is down. It's consolidating. We could very easily see the trend move down again and bring us right back down into kind of potentially this zone down over here. So there's a lot. The small caps tend to lead the market. They are refusing to move higher. When we look at technology and large caps, more or less, they are trading up at new all-time highs, and the small caps are floundering. These should be rocketing higher if this market, I think, was really going to take off for a multi-year rally, but it is really kind of floundering. It's poked up and selling off and just not showing any real traction there. If we go and take a look at the SPY, let's take a look at the SPY. We'll go to the weekly chart. Let's go and take a look at what happened back in 2000, the 2000 market top and the 2008 market top. Over here, we saw the market make a high, and then it went into this complacency rally and came up for more or less a double top. It doesn't have to be dead on perfect. It just needs to be close. There just needs to be two peaks close together for a double top. And then the market had a multi-year sell-off. We saw the SP 500 sell off from that peak. It sold off about 50% there. And then, of course, we got into 2008. It put in its first high, had a sharp pullback, and then it rallied up, and it pierced to a new all-time high for just a week. Maybe, depending on how close these are, potentially 3 weeks. It was flirting up in new territory, and then it sold off and had a big correction of roughly about 55% to the downside. And this is the type of scenario that we're in. I believe we're in a topping stage in the markets. Now, this topping stage that we're in right now, I believe has been dragged out quite a bit simply with the Fed and everything that they do to manipulate the markets. Let me just... So we are in a topping phase, and I believe we're poking to new all-time highs to really get the shorts out of the market. And then for the anybody who's not long to jump in and say, I can't take it anymore. I got to get in. I'm missing the boat. And they pile in, and literally they buy at the high, and then the market goes and crashes. And so we're in this, oops, let me just move over here. We're in this potential major topping phase right here. And we are poking up. We got a high. We've got this complacency move, which is ramping up for a nominal new high. And then potentially this could literally break down, and we go and see some massive unwinding in this pattern here. This is a huge topping pattern. If we were to just take the height of this pattern, we can take that height and we can move it to the downside if it was to break, which goes to show how far that could drop, which from where we are right now is a pretty significant drop in the market. And while 53% sounds huge, it is really just the norm. We have seen that over and over again. Each of the last stage 4 declines in the stock market have been 50+%. And that will just bring us right back to the COVID lows before all this noise. Right over here, the markets were pretty much ready to put in a pretty major top already. They already had a major broadening formation, a megaphone formation, meaning volatility is increasing. And that is usually a bearish sign. And then we had COVID hit and things crashed, and then more or less helicopter money for everybody, benefits for everybody, and the markets took off. But so now we've got a new top. When the markets were ready here, I believe, to top, markets got trumped to push and pushed higher into a bigger top. So we could come back down very easily for this type of correction. And first, we need to get the market has to get everybody offside. That's what it does best. Try to get the majority positioned in the wrong way. And that is to get the shorts out who are betting on this drop that we're talking about. And then those who missed out on the big rally that we've been long are going to get in because they can't take it anymore. The FOMO kicks in. So that's kind of like it from a very high level, big view of where I believe we're at. Now, while I do think there's potential for a massive correction, doesn't mean it's going to happen. And again, this is because we follow the markets. We just need to know mentally and be mentally prepared that this type of thing could happen. And we will see a big reset across real estate, and all kinds of different assets are going to have a reevaluation event. And I think one of the best assets next year, or sorry, not that next year, but this year, I believe is going to potentially be the US dollar. I think the US dollar is building a base here. I think the stock market is going to sell off, and we're going to see the dollar rally back up and become a very big defensive play. We've seen this in the past. We saw the dollar take off during the 2000 stage 4 decline. We saw the US dollar rip higher during the 2008 stage 4 decline. And I believe we're going to have a 2024 stage 4 decline, and we could see the dollar rip higher, whether it comes back up to this high or gets back up into these highs. But I think we're going to see a huge move up. And I think there's a very good opportunity potentially here to avoid a lot of chaos in most assets and ride something up that is relatively slow moving percentage wise, relatively conservative asset. All right, let's take a look over at precious metals where we're at. We are seeing gold pulling back a little bit. If we zoom in here, it's really just kind of taking a breather. It's still very bullish longer term, but again, if we get panic selling in the stock market, it will pull it down. But overall, this is a time where we see gold and silver miners, they could come into favor here. A month or 3 before the stock market puts in a top. So there is potential here for volatility. We could see a big rally and followed by a big move down with the bear market. Overall, I'm not super excited about this sector just yet. If we look at gold miners, they continue to struggle. Excuse me. Lots of chop, lots of noise, and really just a kind of a trendless asset at this point with a lot of volatility that can really shake you up. Silver down almost 3% this morning, continuing to unwind as that speculative play. Again, if you're really looking for a safe haven type of move, precious metals to move up, gold is by far the most stable. Moves the slowest, which means you can invest more money in it. It holds up better during chaos and difficult times. It still will move down, but it won't collapse like 65% like silver. It'll collapse half of that and hold its value much better. In terms of, let's go actually take a look at the markets here. Let's look at the SP 500 and let's just go here. This is January. Here's 2023. If we look at the price action from last year, more or less we have, the market rallied up into June, July, put in a major high right in here, and then it sold off into the end of October. And then we saw that multi-wave rally into the end of the year. Obviously, nothing goes in a straight line. There was a rally and a pullback, but the overall bias of higher pricing followed to near the middle of the year, and then down, and then a rally. If we take a look at the seasonality chart, very similar. We have a rally up. We even have a peak in February and a pullback. We actually did see it peak in February. It tops out sometime in June, July, and then pulls back to the end of October, and then has that multi-wave rally going forward. So right now in January, we are in a bit of a choppy phase. It'll be interesting to see how things unfold. The saying goes, however January closes is how the year will close. So if January closes with a positive bar, then we tend to see a positive year. It's actually pretty accurate. And if it's negative, then we have a negative year. So it's going to be very interesting to see how January closes out. Again, this is just interesting stuff. We don't trade off any of this. It's just nice to know what seasonality wise, what prices tend to do, what some of the stats are about, months closing and what it means for the year. It's just all interesting stuff to keep in mind. But overall, we don't trade off of just thoughts and, this type of thing. We're trading off pure managing trends, managing positions, risk. But it's nice to kind of get an idea of what the market is likely to do. January is relatively choppy. If we actually go and look at January, I fast forward to here, you can see January has been choppy. It's been pulling back and chopping around. We're getting a nice little pop here now up to some new all-time highs. Let's take a quick look at Bitcoin. Not that I trade it or invest in it. I own some, but that's about it. We had the ETFs coming out, another ETF for Bitcoin. We saw a bunch of people front run this. We started to see volume pick up. People piled in on some news, and then some big money slammed it. And then we started to see it try and push higher. It squeezed up and it rallied fairly significantly the day that it launched. There's some increased volume a couple days before. The day it launched, it spiked up, and now it is down, 17, 18%. catching most people off guard. People buy the hype, and then they get chewed up and spit out for a big loss. Now, this might continue to go higher, but overall, short-term trend has flipped to the downside. This is a perfect example of I'm working with a guy who's not involved in the stock market or this type of investment at all. And the crazy thing was, I mentioned this on the day. I said, you see Bitcoin? It's all over the place today. He goes, yeah. He goes, I heard all about it. There's a new ETF out there on it. Like, this is a guy who doesn't know it. And that is like a red flag. The second somebody who doesn't know anything about the markets hears about it and they think it's interesting, the market just crashes, because it's literally finally reached everybody it could possibly reach. Not only those involved in the markets, but now those who aren't even involved. So it would have lured them in at a peak and dropped them down and sold off. So definitely need to be aware that trading emotion and news is super dangerous. And if people are talking about something and they're not even involved in the markets, that is a big red flag you need to be very nervous about. This was a signature move. We talked about it the day that this happened, I think with the band newsletter. Can't exactly, maybe it was the day after, but overall just crazy how the markets can suck everybody in, chew them up, spit them out, and take them for take their money. Looking over at the bond market, bonds are up again here. Let's take a look. If we look at the bond market, we've had a very nice, strong rally. It is above the key moving averages, more or less, and it's been having a nice controlled pullback. This feels like it could have a strong run. If we zoom back in time here and look at this pattern, we could use Fibonacci extension. We got a rally, pullback, here, and this shows where the upside targets are. 618 is the first target, 100% for the next one. My general rule is if there is previous resistance just below the 100% measured move, then this really is the 100% move. It's going to run into some serious headwinds. Come up here, might pull back, and then come up and stall here and trade for a while. But there's potential for a nice rally in bonds. With that being said, if we move back in time here and we go and look at some of these rallies here, we've seen very big patterns like this before. Rallies up, it consolidates, looks bullish. We've seen even the markets, sorry, I'm all over the place here. If we go back here, the market had a strong rally. It had a pullback. It was primed and ready to have another push up. Instead, it consolidated. It built a launch pad. It looked like it was ready to rally, and it rolled over and died again. And we've seen that over and over again. This rally that we've seen here in this pullback is very similar to this rally and this pullback. It could easily take off and go up, but instead it went even lower. So we are still in an overall bearish bias for bonds, but it is slowly starting to flatline and work itself up. Lots of volume. Tons of people picking a bottom here and getting positioned in bonds. Doesn't mean they're right. And even if they are, they're still really trying to pick a bottom because things haven't fully shifted yet. So this is a lot of speculative trading going on and positioning. If it pays off, that really reinforces their brains that they can pick bottoms and they're going to be able to pick tops. And they will lose. They'll make a lot of money on this trade, but the next one and the next several that they try to pick will end up taking their money. So it's just a long-term game. You don't want to play. It's a very costly long-term game, giving you false beliefs about being able to pick tops and bottoms. I can't do it. Most people can't. If you do, it's just more so a fluke. And you just need to manage positions and risk and follow trends. Anyways, I think that's about it. Video's dragging out a little long, but I think we covered a lot of interesting things. I think we're pretty good in terms of the price action. We'll see how things go. The stock market today, we're starting to see, let me just flip back to the SPY. We are starting to see our FOMO indicator get close to this blue line, which is a panic selling level, or not panic selling, it's FOMO, meaning when we see the red level get up to this blue line, it typically means everybody's piling in. They're literally buying in because they're missing out on this rally, and then the stock market goes the opposite direction. If you notice right here, whoops, I don't want that. However, I get rid of that trade bar. There we go. If we take a look right here, we had a gap up and people felt like they were missing out on the move. We got FOMO and then they bought in and the market sold down. Well, we've got a gap up. We've got the markets ripping higher. We could get FOMO today. We'll see how this unfolds, and then it could very easily have a pullback. It might just be a small pullback. It could be a major market top. Well, we will see. But interesting price action. Not that we're focusing on trading any of this short stuff, but it is nice to know kind of day to day what the overall bias is. And, people are having an emotional ride. We are at a 3 rating right now, which is a level where people are feeling very stressed. They're missing out on the move. They got to get in, and we don't feel like that. Now, if you're not in a position with CGS, if you're new to the service, I can't tell you exactly what to do. I can't give any one-on-one advice. Everybody's situation is very different, but the general rule is best to wait for a fresh new trade setup because we're way up in the nosebleed section. There's a very high probability. Not only is this trend going to come to an end statistically wise, but we're poking to new all-time highs and everything is starting to look like, a pretty major market top. If you feel like you really want to get in, you can take a very small position, get your toes wet so you're part of the ride. You'll get a little bit of a feeling of things. It does definitely change the game when you got money in it. And you follow the strategy. It is a very good way to learn and to get a feeling for it, but a small position just to stick a toe in the water. So you're part of the journey and learning with some of that emotional ride in the background, which makes it definitely the real deal. Anyways, that is it for now. If you got any questions, remember, send us an email and we'll get back to your support ticket in the members area. Take care. Bye-bye.